Welcome to The Power of Tax Defense Attorneys, Tax Corner with Juda Gabaie.
Welcome to The Power of Tax Defense Attorneys, Tax Corner with Juda Gabaie. I'm your host, Sophia Morales, and today's episode is the trust fund recovery penalty, what business owners must know. Welcome back, Juda.
Hey, Sophia, how are you? Thanks for having me on.
What is a trust fund, and what's the trust fund recovery penalty, and why is it a serious issue for business owners?
So the trust fund recovery penalty, known as TFRP penalty, is one of the most severe penalties the IRS can impose. And it's absolutely critical for business owners and managers and secretaries of businesses to understand. The trust fund recovery penalty is known as the 100% penalty. It's a penalty imposed against individuals who are found to be responsible for collecting, accounting for, and paying for over certain taxes. Those taxes tend to be federal income tax, Social Security tax, Medicare tax. And you have to be responsible, you have to be a responsible person, and at the same time, you have to be willfully failing to pay those taxes over to the government. These are called the trust fund taxes. Generally, trust fund taxes are employment tax, which is the withholding tax, payroll tax, and also sales and use tax. So an employer can be personally liable for those taxes, and that's usually withholding and the sales and use tax.
Okay, so the corporate veil is not going to protect you on this one.
Correct. It's a serious issue because it's not like other business debt. The TFRP, the trust fund recovery penalty, allows the IRS to pierce the corporate veil and hold individuals personally liable. Because what would happen is you could potentially have owners of a company create a company, run the payroll tax debt, and then go on and create another company and continue doing that. So Congress stepped in order to hold those individuals personally liable for it. And an S Corp, a C Corp, an LLC, the government, if there's a payroll tax or there's a sales and use taxes, they're looking to come after those owners. And it could be owners, it could be secretaries, it could be accountants. It's very important to understand that, there's a criteria. You have to be a responsible person and you have to willfully not fail those. And those are criteria that the government will be on the lookout for in order to determine who's responsible. And I've seen them go after secretaries that have no position in the business. I've seen them go after receptionists because they're signing checks. They're making payroll. Yes. So it's very important because they can go after not only the owners, but other individuals in the company.
Okay, so this is something, if your boss says, do this, don't do that, there may be a point where you want to go, yeah, I can't play that.
It could be. It's important. Yeah. It's important to understand, if those taxes are not paid, you could be a responsible person.
So how does the IRS start to pinpoint who they are going to hold personally liable? What does their investigative process look like? How do you end up in their crosshairs?
Right. So like I mentioned, there's two criterias, right? There is the responsible person and then willfulness. So the IRS will look for individuals who have authority and control and direct the payments of the business funds, right? This isn't just limited to like the official titles that we talked about, right? The business owners, CEOs, CFOs, right? They'll investigate who has the duty to collect and to pay over the taxes, who signed checks, who has authority to sign checks, who makes decisions to pay creditors, who had knowledge of the unpaid taxes. These are, specific things that the IRS will look for. And then in willfulness, it doesn't necessarily mean a malicious intent. Willfulness means that the responsible person either knew the taxes were unpaid and intentionally disregarded, or acted with reckless disregard, and instead of paying the IRS, paid other creditors. So while at the same time knowing that there's payroll taxes due. So these are two criterias that the IRS will look at. And usually this is done by an agent called the IRS revenue officer. The IRS will usually assign like a revenue officer to the case to take a look at that. They'll want to do interviews with the owners or employees of the business. They'll review financial records, they'll summons bank accounts, they'll summons the bank signature cards to see, okay, who could be a responsible and a willful person for this tax liability. So that's what they're looking at. It's those two things, responsible and willfulness.
So what are some of the biggest surprises you've seen regarding who the IRS has pursued for this trust fund recovery penalty? Even individuals that seem well outside of the typical executive roles.
I've seen IRS, besides the CEO, CFOs, and owners, I've seen them go after bookkeepers, the controllers, payroll managers, even silent partners or investors, outside accountants, and even employees. I've seen, secretary, reception. I've seen them because they have signed checks. They're aware of all the bills, the business has to pay. So I've seen them go after them. And it's very important, when that happens, or when there's an interview, or when there's a revenue officer assigned, a tax attorney should be retained in order to mitigate the damages. So it's very important whenever the businesses have some sort of tax liability, whether it's withholding or sales and use taxes.
Wow. I'm thinking of this like from the hapless bookkeeper point of view here. It's like I've
Yeah.
been told to do X, Y, and Z, and I've been following orders, and now all of this starts to come raining down on me. Is it important for you to get your own tax attorney in that circumstance, even if the business already has their stuff going on around it?
Generally, yes. If you've been asked by the IRS for an interview, for example, let's say an individual, you should hire an attorney. Even if the business has a liability too, a tax attorney should be retained, especially when it's payroll tax or sales and use taxes, because they're looking to collect that debt from the individuals. And they will go after them. And the government only has usually about 3 years, at least on the IRS payroll taxes, to go after those individuals. So they'll be on the lookout. Usually, when there's a liability due, within a few months, they usually assign a revenue officer to the case, so they can start doing that investigation.
So is that like the first step that they take, or how does this investigation typically roll out?
Yeah, usually what they'll do is they will send notices, and then after a notice, they'll assign a revenue officer to the case, an agent of the IRS, and then that's when they'll start investigating and taking a look, at that information. So it's very important to reach out to, like defense attorney immediately before responding to any of these IRS inquiries or giving any statements. One should seek legal counsel as soon as possible.
Okay, so is that what you would say the first step should be when you get one of these notices?
Oh yes, yeah, you should. Yeah, you should seek legal counsel for that because they're
Okay.
looking. Look, if they're interviewing you, right? They're
Yeah.
looking to see who's the responsible person.
So what are some of the key strategies and approaches you use to defend your clients when the IRS is trying to hold them personally responsible for example, payroll tax issues?
Right. So obviously, it boils down to responsible, right, and willfulness, right? So the question is responsible, and you want to take a look at what responsibility this person have, right? What sort of authority, control, were they limited in their role, no knowledge or access? You could be, for example, we had investors, right, in a business that we were representing, and those investors have no clue what's going on with the business. They're just investors, but their
Yeah.
name is on the bank signature card, right?
Oh, sure,
And
yeah.
they racked up payroll tax liability, but we were able to prevail and show the IRS, hey, look, what sort of responsibility they have, right? They have no authority. They're just investors in the business,
Yeah.
right? And as investors in the business, they're not involved in day-to-day operations. They have no idea what the day-to-day operations are. So you can't hold them responsible. And how can they be even willful if you think about it, right?
Yeah.
If you're not even aware of it, how can you even be a responsible person? So, we have seen that. We have seen it happen with secretary too, where, the secretary was asked to just sign the checks, has no knowledge of what's owed and not owed, is not aware of the payroll tax liability, is not aware that the owner hasn't paid it. Rather, the owner wants the secretary to sign the checks because he's out of town or he's not available all the time, he's traveling. So
Yeah.
we have seen those cases many times, and it's an unfortunate situation because an owner definitely does not want to see one of their employees or colleagues to be responsible for something that they did wrong, right?
Yeah.
And generally, they want to take the full blame for it, but the IRS is always looking to go after everyone because if they can the more people they can go after, the
The more
higher
money
it is
they can get back.
right, the higher chance it is that they can collect that money back,
Yeah.
right? Usually they'll go after many people and they'll assess that liability to those people, but they're not looking to collect from each person that amount. They're looking to just collect this full amount. They don't care where it comes from, and they don't care if it comes from 100% from one person or from the other person. At the end of the day, if this trust fund is paid off, then that's it. So if they go after 5 people and they assess 5 people for that liability, they're not collecting that 5 times. They're just collecting that one time, and they don't care if it comes 20% from each one or it comes 100% from one. They're just looking to get that liability paid. So that's why they make a big deal about it. Remember, at the end of the day, this trust fund is money that you withheld from your employees' wages or you withheld from sales tax, and you didn't remit it to the government, right? So now the government wants their money. It's more like, if you think about it, like an embezzlement. The government,
Yes.
you're supposed to hold this money and then remit it to the government, which you fail to do so. So that's why they're looking to go after as many people as possible.
So, what are the larger consequences or the long-term consequences of mishandling a trust fund like that or ignoring the recovery case?
So they'll assess this liability against you personally, and they can go after your personal assets, right?
Mm.
They'll have, the statute of limitation is 10 years for them to collect the liability. They can go after you personally. They can levy you. They can lien your assets. They can take collection action against you. Very rare, it could be credit damages. You'll get assigned a revenue officer to try to collect the debt. You can't file bankruptcy either on withholding tax on sales and use taxes. You can't file bankruptcy on that. It's not dischargeable in bankruptcy. So that means they'll follow you all around until it's either paid or until the statute of limitation has passed. But there are options, right? There are options that could be done. I mean, if that were to happen, you have resolutions. I mean, you could possibly do a settlement. You could do a payment plan. They could do a hardship status. It all depends on what you qualify for, but you have options to try to get that resolved.
Oh, that's good because it was sounding really bleak there for a minute.
Right.
So, what are some concrete or proactive measures a business owner could take to protect themselves and their staff from a situation like this?
It's very important to keep it separate. So maybe keep the trust fund money separate, where the owner is only responsible. He's the only one that signs the checks on that account. He's the one that remits the payments to the government. Generally, I say use a reputable payroll service to take care of that for you when it comes to that. Also, same thing with sales and use taxes. And the owner should, designate clear responsibility. Who's in charge? Who's in charge of the bills? Those are very important. Then maintain very good records, right? Because at the end of the day, the IRS will try to summons and see who's that, responsible person. And then obviously, I mean, you could always, hire a tax professional, a tax attorney to just make sure everything's being done in a clear, so there's no issues, later on.
Exactly. Well, I really appreciate you digging into the details on this today.
Yeah, it's a lot of details. It's a tough one. Trust fund is a big deal. The government makes a big deal because they want the money. It's for them. It's like, why is a business owner taking a loan and not paying it back? It's not their money, so they make
Yeah.
a very big deal about it. That's the reason why they impose this 100% penalty. That's the reason why Congress gave them this ability to go after the individual owners and the people that are responsible. So one thing I tell business owners is it's very important to not, to overlook that. It's very important.
Yeah. So take it seriously and be very
Yeah,
fastidious about it. Yeah.
100%.
Thank you so much. And thanks for listening to the Power of Tax Defense Attorneys, Tax Corner with Juda Gabaie. To connect with Juda, visit reliabletaxattorney.com. And remember to leave us a comment, like, and subscribe and review wherever you listen to the podcast. And we love hearing from you.
Thank you for having me on. Appreciate it.
Thanks for watching. Be sure to hit that like and subscribe button and leave us a review in the comments.